All right. Well, welcome everybody to another podcast. This podcast, of course, is sponsored by the Pie Shop and also by Blue Dolphin Design and Engineering, both located right here in Central California. Wonderful place to do business and to start a business. Today, the subject of our podcast is investability. So most people think about this when they're starting a business, especially if they're thinking about selling their business or their idea. It's a big part of it. And there are many misconceptions about how this works, I believe. And so we're going to try to define some of what's going on with all that in today's podcast. And to help us with that, I'm really happy that Emory Wishon is here to help us out. Thanks for being here.
Thank you, Mark.
Emory is has a Bachelor of Science in Economics from Brown University, an MBA in Finance from the University of California at Berkeley. He's got his Juris Doctorate from the Stanford Law School. Currently, he's the managing partner of Motschiedler, Michaelides, Wishon, Brewer, and Ryan LLP. And he is the past recent chair of the Central Valley Angel Group. So highly qualified, and this should be pretty informative for most people. So the first thing I think we need to talk about, there's a lot of different ways of developing a business. Some people are developing their businesses to run it, to actually make a go at it and make it their business. There's also, of course, a lot of people who are starting their businesses in the hopes that either they will sell their idea or potentially sell their company, being bought out and making loads of money, that kind of thing. That's the typical thought process for what might happen with a business. There's other variety of ways this can go too, but so I think one of the first things we should talk about are actually what are the different types of funding that actually is available for a business. I mean, what kind of things are there available for business owners?
Almost inevitably, the people who are starting the business use their own money and their family's money, their immediate friends, and that should be and is the first pocket to go to. No, there's no one who can believe in you until you believe in yourself, until you have reached out. So you're using your sources. Occasionally, and I've seen it, people have come to us as an angel investment group and have been deep into credit cards. Not a preferred strategy, but people use their own pockets first, and they should. And then when they have a set of attributes that make some sense for someone else to come in who is not already a part of their, literally their family and super close friends, then they have the ability to reach out to others, investors really, but angel investors or occasionally larger scale investors.
Yeah, I know, of course, over the last 2 decades with Blue Dolphin, we have had a number of occasions where people have asked us to invest either through equity position or something with their companies. And often my question is, what were they willing to put on the line to make that happen? Because in essence, if they haven't put their house on the line to make this work, then why should I put my house on the line to make this work? And so being dedicated, I guess, all in, and maybe having your family help you, that's definitely a good indicator of how much they actually believe in their own idea.
Some ideas are relatively cost efficient to start, but many take $100,000, $200,000, and occasionally much more than that to get to where there's an investable idea or product that can go outside.
Sure,
and
sure.
That exhausts most people's cash reserves.
Yeah. I like to tell people, I say, if you're going to have a business, to have a business, you have to have cash. And and one form or another, at one point or another, you have to have cash or be making money. And that all plays into what you just said. So a lot of people talk about debt financing and equity financing, and we are trying to inform people here of the different types of ways of getting funding. What are the basic differences between debt and equity financing?
Well, in a strict balance sheet standpoint, you're trying to produce assets on your left side, and the sources of doing that are either equity or debt. Debt is borrowing from somebody. It could be literally yourself if that's the source. And equity is to allow somebody to be the owner of it. So you're funding the asset side with either debt or equity on the liabilities and net worth side. And it can, there are many forms of debt. Credit card debt I just spoke about. People can borrow against their homes, as you have just said. Whatever the source of that liability is that produces the asset of cash that is investable by hiring people, by designing products, by doing things that are necessary towards developing that business plan and that business idea, and in time that business plan. And
so the debt part is where you basically where you're going into a hole. I mean, a hole of money, and you have to be able to, at some point in time, get out of that hole, right? So, whereas equity is a little different, right? It's where people are willing to take a piece of the pie. Hopefully, there is a pie, right? I mean, isn't that kind of the difference? Or
absolutely, when a business enterprise is attracting equity from someone, they are giving up a share of that ownership. All investors want to be owners in a rising business, and so what you as an entrepreneur are seeking from them is that cash that helps you to drive the business forward, and the asset that they provide to you is cash, and you give them equity. You give them a share of that. Sometimes you give them equity, sometimes you give them debt, but whatever it is that induces them to participate with you, and they all, if they take debt, they want equity. It's just a means of starting out and then converting in time that ownership interest, which may have been funded with cash for a loan, into equity.
Oh, okay. Well, that's a good point. Yeah, right. At some point in time, if an investor is always looking for equity, really, even if he gives you debt to begin with. So unless you find your own debt, like a credit card or something like that. So now a lot of people throw out the term venture capitalists and angel investor and sharks and things like that. Well, there's differences. I mean, can you give some basic differences between what an angel investor might be and a venture capitalist?
Sure. Those are 2 points on the spectrum. They're important points to understand, but it's really a continuum. One might find, first of all, an angel investor is typically a local person or business. We Central Valley Angel Group that I'm a part of, have 28 people. We assemble and choose companies that we will support, but we're not trying to we're trying to invest in those. We provide some mentorship. We provide connections. We want them to succeed. We don't want to be, typically we don't want to be on the board. We want to help them succeed, and they are driving forward. Venture capital, as a far larger amounts of money, typically, and much more control of the company, will come in and want to have a very significant volume of equity, will want to sometimes to relocate the company, will want to be more than a voice in that. They will want to have a loud voice in the company, and they'll take a much bigger share of the equity than that. So there are individuals that are not a part of angel groups. There are intermediate funds. There's a Central Valley Fund, which happens to be a large fund active in the valley that puts equity in the funds that is at a high level. But anyway, they're dramatically different, but they are sources of early equity participation, or sometimes debt as a method of getting there, equity participation in a growing company.
Oh, okay. So angels are kind of like, they call it the seed part, just like a plant. It's the very beginning. You don't know what you're going to get. You're planting the seed. It's high risk. The venture side of it, the venture capital side, is more, it's established. They may actually be revenue at that point. They may have an actual business that actually is doing something, and they're looking for more serious investment.
Let me pause there. Our Central Valley Angel Group looks at companies that are really at the threshold of initial revenue. We prefer that they have revenue, but it is not universal. And we'll certainly look at ones that are at the threshold. They've got a product, they're ready to go, but they may not have gone anywhere. Conversely, the venture capital companies are looking at more mature. They already have to have a track record. They ideally will have that base and several other attributes, and then be ready to spring forward.
Gotcha. Okay, so it's kind of along the development path of the business. You have different varieties of investments. So, well, let's talk about a couple of the different types of investment deals. I mean, a lot of phrases thrown out there, and once again, we're trying to clarify some of what's said often in conversations, but people don't truly understand. Maybe there's different types of investment deals, such as a convertible note, and an equity stake, and safes, and kisses, and for example, what's a convertible note? What's a convertible note?
Every entrepreneur knows that every investor wants to participate in the upside. And you don't participate in the upside very much by loaning money to a startup. That's a high-risk event, and debt has a limit on what one can get. A convertible note is the kind of icing on the top of the cake here, where the debt from the company borrows, say, $50,000 from the investor or group of investors, and the conversion is an undefined, at the beginning, value of equity that will come out later. Coming over here, I was trying to think of how to explain this relatively simply, but in a very early company, it is very difficult to quantify the value of the company.
Right. And
the method that is often selected is, and we as Central Valley Angel Group have 9 investments, and we have more or less $100,000 apiece. Every one we wanted equity. Every one we have is a convertible note. Convertible note is a debt, in a sense, a conventional note with an interest rate and a maturity, and typically nothing to be paid until the maturity. And then ideally, it has a conversion where one is going to get a certain value. If you put in $100,000 and the company is worth $1 million, you would get 10% of the company, but you don't get it for a while. And then there's also the way in there to if the company actually becomes worth $3 million, you get more value, but a discount off of the price that the others get. So you get an upside. It's very important to get the upside. And as I said, no investor except for immediate family is so willing to put money up for debt that they don't care about the conversion to equity.
Yeah, so high risk, of course, and I think the percentage of investments from angels that actually return like a 10 times investment is fairly small. But
correct. Sadly,
yeah, which is why it's high risk. Which is why when you do a convertible note, for example, you want to get equity and also you want to be given the discount if it does increase in its value. Since you were the one who took the risk early on, you're getting this discount. I mean, that's the reward for taking such a high risk. And often the company needs to be aware of that's what the investor's looking for. They're not just trying to loan money like a bank does, because they're not interested in the typical bank rates, especially the rates that are out there right now. And so they're looking for a better return on their money. And there's also the philanthropic part of this. I mean, they're not willing to, I don't think many investors are willing to donate their money, but they definitely could believe in a product or a business or a.
That actually goes back to the parts that we were speaking about, an angel investment group versus a venture capital. Angel investor groups always, I think, have local investment success in mind. They are universally, as among our group, and I believe among others, they really are trying to do something which is important regionally, and so that employment, that success, is absolutely important. Conversely, I think a venture capital firm has no regional loyalty, and is will make the investments in different places that they think make economic sense,
yes,
without any regard to the local impact. That makes our group more interested in Central Valley investments.
Yeah, which is a good thing. I know I've seen a study recently that showed that investment in startups through incubators, which typically a lot of them get financial help through investors, that the return of investment for every dollar invested, if they are successful, is about 5 to 1. Well, that's a pretty good ratio of good for the community, to invest $1 and to get $5 back to the community eventually, either through hiring, through whatever the case may be, doing commerce or whatever. That's pretty good return. So it's a noble cause in some ways to be on the angel investment side of it. And
we describe it to ourselves and to others as that we are seeking economic return. We pure philanthropy we each do, but that's a different function.
Sure.
But we are very interested in the success in the valley and job creation in the valley, and in creating economic opportunity in the valley, all of which is aided by these higher risk startup opportunities.
Right. Okay. Well, so we talked about a convertible note, which is kind of thrown around quite a bit with investors. There are definitely some tax advantages and disadvantages to these different investments. Convertible notes, although they may seem like a more simpler avenue, don't always have the tax advantages some of equity type investments, where you're taking strict equity, I guess. But one of the things that's important to all of these investments is valuation. All right, and everybody thinks their company's worth $1 billion, whatever it is,
Correct.
And they like to throw those numbers out there. But the reality is, I think, and this is what I'd like you to kind of address is what there is actually a process. You don't just kind of pull it out of the air. It's just of creating what the company's valued at. I mean, what are the things you look at?
Well, in that our my Central Valley Angel Group, I'm actually active with two functions in that area. One of them is Central Valley Angel Group, and I am the chair of that and have been for several years. The other is through Fresno State. New California Ventures is a part of the Fresno State Foundation as a LLC, and it invests and has invested successfully in two companies, one of which has a product I hope we'll talk about
Yes.
as a product idea. But the valuation for a company that literally has no revenue or a few months of revenue is remarkably difficult to pin down. That's actually the strength and the reason behind these convertible notes. Nobody knows the difference between $1 million of valuation for the company and $5 million when the company has zero revenue. You cannot create a revenue, cannot create a multiple, a data set that gives you confidence if there's nothing available. But I can tell you that every company that we work with has a product that fits into some market, at least that we have to describe the market, even if that's a truly an innovative product. And then the ramp up of what number of people and what number of units of sale and what number of product dollars have to be in place in the marketing system in order to ramp up. And then typically the tipping point of this investment is to drive the company from a startup level, a very modest level where it has a minimum viable product, MVP, and then can describe with some confidence how to ascend that projection.
Sure. So okay, you mentioned minimal viable product. That's important. It can't just be a concept. Whatever that product does, it seems like you should have developed it to some extent so that you know it exists in the real world, whatever it happens to be, even if it's an application, I guess. You'd like to think that they've done some marketing analysis to figure out how big their market is and that it's realistic and that they may be able to actually achieve some market share, right? So
our website and the companies that present to us have a structure about describing the market, what their anticipated market share is and why, what each of their competitors and how they distinguish their product from what is on the market and what their system is. So there's a in for us and for others absolutely available is an important set of ways to present, ways to think these through, develop a business plan. We haven't quite gotten there, but a business plan is hugely important, and then the presentation of that business plan is extremely important too. Your investors need to hear what that plan is. I'm veering off your valuation question.
Yes, right. No, it's actually I think it's relevant. So.
Okay, but the investors have to believe that you have a very capable team. Actually, what distinguishes it? This is veering off to something I wanted to say here. If I get to, what distinguishes an investment that we want to look at? The team that is the management team. What experience do they bring to the table? What's their capacity to? If they've failed before, that's okay. We want to see that. If they've succeeded before, we want that. But what experience and skills do they bring to the table? Product. What is the product? Why do they believe in it? Why would we believe in it? Business plan is the ability to describe why these people and this product with some money can do better than they could otherwise, and that's extremely important. And the last of really is traction. I mean, if they have not had a sale, then we're always saying we want to see that first sale. We've invested in ones that have zero revenue still, but traction. Why is this meaningful? Why is this story credible?
Sure.
And those elements are there, and our threshold of pain is and as an angel, and this is probably somewhat typical. We'll look at companies that sometimes have less than $2 million of market value, meaning $100,000 would be literally 5% of that if we converted and got equity for that, and as we approaching 10 million is our kind of sweet spot. That not the preferred higher end of that. The lower end of that is our preference, because back to valuation. What we have to believe is that we have a chance of getting out of it at 5 or 10 times the value that we enter.
Mm-hmm.
So if we we put $100,000 and have 5% of the company, the company has a potential for making us 10 times that. If it happens once in 10, it's about what one should look for. Sure. And there will be several zeros out of that, and
yes.
That's part of the process. But it is trying to create a coherent statement of value is actually very difficult.
Right. Yeah, and very important. A couple things. I know you talk about a business plan, and I think business plans are very, very valuable. Like most plans, as soon as you try to implement it, it goes awry. But like all plans, I should say. But the thing about a business plan is, I believe what it does is it makes you look at all aspects of your business. Just take a look at it. And if nothing else, you've actually looked at all aspects of your business. And often entrepreneurs, I know the ones that have come to Blue Dolphin over the last 2 decades, they often haven't looked at much of anything except at their product. And when they look at the other parts of what their business might be, they may not even have a business. And so doing that business plan is always a good idea. It just makes you look at all aspects. So I totally agree with that. And I think it's it's fascinating because it's interesting. Angels will take a risk. A bank will not lend to you at that stage in your development. I've been in business for 20 years, and it's still hard for me to get a bank to deal with me sometimes. And so angels are, a good way of potentially getting funding after you've, charged your credit cards up or done the other things maybe that it took to get going. So I guess you mentioned the things you mentioned are you'd like to see that.
Let me go back to number one. Number one is the people.
People.
And we have to believe that the people have the skills, or will learn the skills. One of the words that we pay attention to is teachable or coachable.
Yes.
We want you mentioned this business plan, and we absolutely want and require a business plan. But we also the success stories will come from the people who are learning during that process.
Sure.
Because the first thing that will happen is it's not going to play out the way that the business plan says, and the ability to smartly adjust to that reality is the difference between success and not.
Okay, so team is very important. I understand that. And a team it's always nice to see more than one person. The solopreneur, that can be difficult because most likely he doesn't wear all the hats well. And so it's always good to have a team, even if they're just mentors, at least in my experience. And a business plan, a product that's viable, and hopefully some traction, some sales. So those are four of the main aspects you guys are looking for. Yes. From an angel standpoint, which makes good sense. And hopefully people who are listening, they understand that you need to look at those too, because somebody else is going to be looking at them. The odds of somebody handing you just a check just because the heck of it it may happen on television, but it doesn't really happen much in real life that I'm aware of. So,
speaking of that, one more comment about angel groups. We want everybody who comes to us, and there's a screening process before we get there, but they should feel good about the feedback they get from us. The Shark Tank is a shame because that creates entertainment out of embarrassing people.
Sure,
and grandstanding. Ours and I believe other investment groups are responsible people trying to do good, and even to people who we don't invest in, we give them the information that what was the deficiency from our standpoint, what they might do better, and wish them well. So
yeah, that's a good. I appreciate that. That's fantastic. I know when we have listened to pitches here at the Pie Shop, one of the things we try to do is we're trying to give them good feedback, because we're trying to help them be successful in pitching their ideas. And often somebody can have a wonderful idea, but if they can't convey the information well, then they're losing out potentially on being able to get funding, or just because they can't convey an idea. So I know giving that feedback is always valuable, especially from somebody who is used to doing the investment. So that's wonderful. You guys have that attitude.
Whether they're smarter for having come to us, even not got money, and somebody else will have similar criteria. They can be, everyone is different. But
sure. Well, we definitely have some people we want to send your way. Let's talk. Let's expand a little bit on minimal viable product, which is a little kind of near and dear to Blue Dolphin Engineering's heart, because we've always, that's been what we've been doing for the last 20 years. Is basically either creating the minimal viable product prototype, or actually getting all the way into production. So talk to me about, how important that is, and what you kind of like to see from that.
Well, some of the companies we have do not have a physical product in that, but even they go through the same process of developing a product. It might be software as a service, and some of them are, and some of them are absolutely physical products, but they all need to develop something that has to be tested, has to be created, whether it's code or whether it's wood or metal or something else, has to be examined. Let me mention through Fresno State, the 5 microns is a tremor reduction device that Fresno State's group invested in, and Tay Wynn is the wonderful mechanical engineer.
Yes,
and it's a very physical product which continues to go through permutations of improvements.
Sure.
And they're still at a zero revenue point.
Yes, but
are substantially gaining. So the ability to continue to revise and improve, and in that case reduce the size and weight of the product that works, and to have the physical, in that case, physical product to take to the doctors that help the persons with tremors,
mm-hmm.
and respond to the patients and the doctors in that. Anyways, it's irreplaceable.
Yes. Yeah. We talk about prototypes. We've made many prototypes over the years, 3D printing, you name it. We've done all sorts of processes. One of the things we really like, the message we like to convey to our customers and the people we work with, is that often having that prototype in your hand does a variety of things. One being that it prompts more ideas to come up that you didn't originally have in mind when you first started this thing. You get it in your hand and you go, wow, I could do this, this, and this, or wow, I need to change it, it's too big, or whatever the case may be. There's a lot of good aspects, a lot of good information that comes from having those prototypes and developing them to the point to where they become a minimally viable product, just like the word says. It's not normally the process where you go through one iteration and you're done. That's maybe happened once in my entire career, and that's very rare. And so something to keep in mind, that it's just like everything. You have to look at those aspects over and over again. So yeah, okay, wonderful. Well, what else do you want to let the people know about the Angel Investment Group here, and just kind of in general?
There are competitions. There are pitch competitions that are occasionally held at Valley Innovators as among those, and the Central Valley Venture Forum at Clovis Veterans Hall have been among those, and there are more going on, and those are actually very helpful. The ability to create a timeline for a presentation to identify some successes, and while the winner is always important, every competitor is benefited by learning what works on the other competitors, and by having a number of investor persons making judgments about them, giving them feedback, and they improve their own product. So those pitch competitions, which are really just the presentation of the things that we're speaking about, help to create financing opportunities and visibility for the companies that are developing products. You're at a wonderful stage to feed from here into the investment community, and which is, by the way, our angel group and others are we're not very effective without good opportunities. So absolutely, the promising ones that, whether identified by one method or another, are very important to be visible to us and made visible to us and to others.
Yeah, I totally agree on the pitch competitions. They provide a variety of things come out of that. It's interesting to me when I've seen pitches from the same company over a period maybe of 2 years, where they've gone through and they've gotten money and they're actually looking for more money, and they're developing their business and product, that it morphs. They pivot, as people say, because we go from something you thought you were going to do, and you end up going in the direction that you actually have to go to make a business. And these pitch competitions are great places to get good feedback and to also get some understanding as whether or not you actually have a business model that may work, and that people believe that you have, as we've said here, investability. Very good. It's a good point. Very good tip is to be involved with the pitch competitions, and don't expect that you're necessarily going to get anything out of it, except great advice and good feedback.
Right. That's a huge reward. I mean, it's nice to get the prize, but we as our angel group are absolutely not interested solely at who won. We want, and we have through the Central Valley Forum had several of those parties come to us, and we've invested in some. And
sure.
And again, fine if they win, but but fine if they don't. They have already succeeded in a level that is very good. And again, we're sure to give them, anybody who we get a chance to work with will be better off for it. They might prefer to come out with the money.
Sure, yeah, absolutely, yeah.
But they'll, they've got exposure, and we have potential for introducing them to people who will help them succeed.
Well, that brings up one more thing that I thought we ought to talk about, and that is when you are pitching to an angel group or whoever it is, there's the ask, all right? And let's talk a little bit about what the ask and how important that is, and how much you have to have definition of that before you actually make it.
For us, and I will describe it pretty thoroughly. We have a website, and then we have people answer questions and so forth. But we have not been lead, meaning driving the specific investment. There's a slight variation on that. So they come to us in a capital raise. Somebody needs $300,000. They need $500,000, and they want from us. And we happen to be of the size that about $100,000 units are about what we've put 50 in, and sometimes we've gone slightly more than 100, but generally that's as big as we want. So it's already, and we won't loan against other than very competent documents. So there's a security issue. There are requirements for lawyers to have prepared documents that we are using, and the ask is specific. Occasionally we've nudged at it by. So I want to, $500,000, and we will give 5% of the company. Mm-hmm. And we either want in or we don't. Mm-hmm. And we can are basically thumbs up, thumbs down. We've done a little bit of maneuvering where we have asked to be in after a certain level of participation has been there. Mm-hmm. It is a lower risk to be the last 100,000 out of 500,000 than it is to be the first 100,000. Yeah. And yet they're compensated the same. So and it frankly it helps the company to be on the. It helps either way. It probably helps them more if it's the first 100. Yeah. But it absolutely is a big help to say we've got others in, and we'll identify it. Mm-hmm. And we will share with the company our due diligence. One thing that we have skipped over, but it's absolutely a part of the process, is to, from the time we say, yes, Mark, we like what you're proposing, now we're going to go kick the tires. And so for a month or so, a part of us addresses whether this is for real or not. And then it comes back. So we're anyway, very interested in validating the plan. And
so you mentioned a very good point. Due diligence. I think most people, once again, they're used to watching Shark Tank. They think you go on for a 5-minute presentation, you get a check. And I don't think it works that way.
I don't think it works that way on Shark Tank.
Yeah, it doesn't actually, and eventually it doesn't. So due diligence. It's a very important point. Most people must realize, and we try to tell our people that we deal with, that when you're pitching your idea, you need to be honest and don't exaggerate too much. You might want to, because you believe in your idea. I hope you believe in your idea tremendously. So, sell it. But eventually, when it comes down to it, if they're going to write a check, if the Central Valley Angel Group is going to write you a check, they're not just going to write you a check without investigating, making sure that the things that you presented are, in fact, as they are. And all groups work that way for the most part. Maybe your uncle doesn't work that way if he gives you a check, but the angel groups and other investment groups
they should.
And they should. It'd be foolish maybe not to. But so you need to expect that. You need to have your homework done and have your ducks in a row when you go to present. And if you don't know something, say you don't know it. Say you're going to get the information or answer a question later. But be realistic. And when you do make the ask, be specific about what that money is going to be used for, and make sure.
Absolutely, I didn't. Yeah, absolutely, and that is inevitable. Why does this $500,000 of capital, incremental capital, is coming through a convertible note? Why does that drive the company to success? And they may believe it and they say it, and yet we're aware that virtually every 500,000 is followed by another amount. And that's okay. That doesn't, as long as the company is ascending, we are expecting that to happen.
Sure. Well, okay. Well, I hope that everybody watching has gotten something useful out of this. It's just been a lot of good information. I really appreciate Emory being here. Thank you very much.
My pleasure.
I value your experience and knowledge. And hopefully everybody who tuned in got something from this. And I hope you guys will watch our next podcast and join us every month when we do this. These podcasts will be put onto our website, which is the Pie Shop, ThePiShop.org. And they'll be on our site, so you can watch them at a later time, also on our YouTube channel. And so if you want to know more about the Pie Shop, please get a hold of us at the website, thepieshop.org, or you can call us here in the Central Valley of California at 559-481-5004. So thank you once again for joining us, and we'll see you next time. Thank you.